Hey guys, good morning. So we've got a couple of new subscribers and they're asking, what is this all about? How do I use your indicators? So this is a quick video to sort of go through that and also show you how to put the indicators on the chart, walk you through them briefly, very briefly, and then you can go on your own plotting them on your chart or going into a deeper dive and go along the path of using the market analyzer or your strategy builder to extract the data from the indicators. So first we're going to look at what this is. J Auto Trading Strategies. J is for Julie. I'm Julie. Auto Trading Strategies. I started out on this path of building automated trading strategies, and that's how I just sort of designed everything starting out the gate. V-SNAV, that's Volatility Surface Navigator. Clever, huh? And then Halo is the hierarchical, meaning more than one thing, hierarchical in order, like quarterly, monthly, weekly, daily, 60-minute, 5-minute. Analytical liquidity order flow. Because without the analytical liquidity order flow, you're not going to get much from the volatility service navigator, right? You have to be able to analyze it and order. I think the hierarchical order, quarterly, monthly, weekly, even though you have room on a daily to move directionally, doesn't mean you're going to hit the target if you run into a monthly too, right? Which is what we're seeing today, interestingly. And also, you've got your very cool April 10th calendar, today being the 100th day of the month. And it's also the 10th day of the month on the same day. And you know that 10-100 is a um, CTA distribution that they heavily rely on. 365 days of the year, they rely on that distribution, but especially today. And today, everything was centered around this exact point of, 68, 80, ish. And that's exactly what we're seeing so far turn around in the market. But for the variance trading model, I'm mapping things on a proprietary method. I don't use standard deviation the way that the book uses it. In fact, I don't use it. I use a different method, a statistical method based on average range. Okay. And it's a variance trading model. You've got your mean, and you trade to the 1, to the 2, and to the 3, going long, or short, the 1 to the 2 to the 3, going short. Everything is based around this bell curve. The dealers use this and they structure their trade on these statistical levels. It's as easy as that. And these statistical levels, the mean, the 1, the 2, or the 3, or going outside the distribution and measured moves of what the underlying range is. So you would use like 1.25 times, 1.5 times, 1.75 times, 2 times outside the distribution, or any variation thereof. If you like fibs, like, what is it, 32, 68, whatever they are. I don't use the fib numbers, but, or you can use statistical ranges, 34, 68, 95, even going outside. Whatever you like to use, it's all really based on gamma, right? You gotta think like the dealer and the market makers because it's their levels that we make money from. So, are the market makers gamma short or are they gamma long? Once you can understand that concept, you can come over to like your quick options and quickly see you can register for free and get a lot of this for free, but they have a very reasonable monthly subscription that I highly recommend. But definitely check it out. So if I come over here for the GEX on VIX, I can click whatever expiration I would like. This is for next week, the 15th. And you can see that there's a call sitting right here now at 19.5. And 20 is the upside level. There's not really anything on this 19 as far as GEX, gamma, or there's no negative puts on here to show you that it's going to stay, you know, negative gamma. Now, negative gamma for VIX is not the same as negative gamma for the ES or the SPY, XPX rather. Um, Negative gamma is actually bullish. Positive gamma is bearish because it's opposite of what the market is. You have to just keep that in mind. So when you see this negative gamma bullish, we really don't want to be selling the market today. But that doesn't mean necessarily that you're going to be buying it either, especially if the market's running into a resistance area. But get your positive, negative gamma down. If we go over to the SPX, you'll probably see that it is positive for today. Today's April 10th. And yes, indeed, the entire surface is positive. So we really don't want to be selling the market. We want to be buying dips, but in this framework. And here's your high strike at 68.55. And there is a trick I like to use on the investing calendar. If you use the economic calendar at investing.com, you can do a search for this E-mini BTIC basis trade index close for the S&P 500 futures. And when you click on that, you're going to get the difference between, oops, there it is, 38.75. That's the difference between the E-mini futures and the overnight SPX cash index. 38.75. So you have to come back to the futures and add 38.75 to it. So if you take the cash index of 68.24 or 68.55, the market's currently at 24, but the high is 68.55, and you add 38.75 to it, top of the market is 68.88. 68.50 plus your 38.75 got us to 68.88, and that is precisely where, the market is stopping. 68.88 is this yellow line up there. We ran into the JIVE ones. That's my VIX volatility adjusted daily one for the VIX. See, my daily one is up here for the native volatility. That's the statistical range, the 69.05 to 69.08. But the VIX volatility is lower. It's inside that range. This is not a range expansion setup at all. If it was a range expansion setup, you would see those jive lines on the outside of those statistical lines. This is the VIX volatility. And you see that the market is failing on the VIX volatility jive daily ones. And they come back to the mean, which is sitting right under it. The lower mean here is at 68.60, and then of course your 68.50 is the gap close, which has already been hit several times. So, but the RTH session also likes to hit it a lot of the time. But so I would, presume that this market is going to get bought because of we're in the positive gamma. And then probably, do you see how it went right up to 68.88? Right up to the line and touched it? Is that giving you chills? And then it failed. And the 68.80 is our monthly too. So this is that hierarchical liquidity order flow analysis part. We know that the monthly two is sitting there. And what does that mean on the bell curve? That means that it's 2 sigma. And I told you that I use average range. I'm using a proprietary statistical method. So I'm measuring to the second standard deviation of that bell curve on a monthly time frame. And this is the part where we can go right in to show you what the Jats PT is now that you've got it installed on your desktop. You just open your Jats indicator folder, find the indicator that you're going to use. There's a few of them, but you find the PT V3. That's Jats profit targets, and this is my third iteration of it. And if you right click it, go to properties, PT for probability targets. And the second standard deviation is your expected move. So it's the expected move of the dealer range. And here this is set to 31 days. Let me get this on 30. I don't need these fibs. You can turn the fibs on or off, and then you can type in here what you want. You can also calculate on the close or the open of the range. If you're using a month as a period type instead of a day, then imagine the monthly open, the bar of that monthly candle is going to be different than the bar of a daily open, or a daily open 30 times, or the number of trade days in the month. This actually will pull up the number of trade days in that month versus a calendar day where you can just type in 30 because there's 30 days instead of 31 in April. Last month was 31. All right. So you can come in and put your fibs. You can also, let me show you this real quick. On your fibs, I've got everything going outside the PT3 for fibs, but you could move those outside the PT1, 2, or 3. And there is some art to that, especially when you get into very compressed days inside the one. If you get a breakout, sometimes they'll break out to one of those fib levels and then come back in, as a pop and drop, or, you know what I'm saying, a little spike. Dealer tries to, or market makers do this, try to get you to follow them and then come back and eat your lunch. All right. So get all those fibs out of there. So you can see here that it shifted. Um, and I'm going to put the 100 day on here. And when you use this much data, you really want to make sure that you're putting the right number of days to load. So I've got 3,000. You can change it from 3,000 to 5,000. Oops. Or 1,000. Oops. I think that said 100. That's not going to give me a distribution. Sometimes if you don't see any plots on your chart, it's because you didn't add enough days of data. There you go. There's 1,000. For most higher time frame distributions, I'll use a 3,000 period. And also, if you notice your trading hours, the use instrument settings is different for all instruments. It's for ES, it's 1700 to 8:30 a.m. So there's 2 hours missing that could affect the way that the plots are calculated if that open or close shifts between those 2 hours during the maintenance period. And that can happen during like economic reports, earnings, and things like that, or any other news, major news announcement that would come out during that time frame. But otherwise, they're very close together. So you can be aware of that. Your trading hour template's very important. So I'm going to put this back on. Use indicator settings, set it to that, and you can see my volatility did shift from that 31 days to the 30. I had it previously on a 31 day for that monthly level. Um, but we did hit a weekly one and pulled back, and the daily one, and the we're above the quarterly one. There's a 6-month one here also that is very critical. You want the market to stay above that 6-month distribution for NQ and ES. So you can change your month to 3 or your month to 6. See, I've got a 6-month here. And this is the red line. And I'm going to make this one really thick. Right here. So the market is heading right back up to the mean of that 6-month distribution. And when will that 6-month distribution end? June. So 69.38 is going to be thereabouts. I mean, I'm not exactly on the level. If you're like me and you do like to be exact, 66, 70, 25. I see 72.14, 72.14.25. Okay, hang on, I've got a mistake here. I have an extra 7 instead of a 0. Alright, now we're good. 69.36.81. That's where the market's going. And then there's that blue 2 right there, which is a quarterly 2. So you can see between 69.36 and 69.77, we've got a target to trade to. So that's that variance trading model. You can see we're above the quarterly mean. We broke through this dotted line, and that's a 1 period RVOL, as I call it, realized volatility versus 14-period historical volatility. And this is the 3-month one period. So when you break the 1 period, that's very directionally biased long because you're going out from the historical, and the realized is on top of the historical. It's not inside. Remember I said it's outside, so that leads price out. And if it's going out, where is it going? It's going either to the mean of a higher time frame or to a higher time frame 2 or 3. So the higher time frame mean going from the quarterly to the 6-month is right there. And then there's that quarterly too. So you can see that that is the target that's going to be on market makers' radars, 69.36 to 69.77. And you can see that we've got a RSI going straight up into the level now. So there's nothing bullish about this market, which is why everything was positive on the ES. But we've run into some resistance today at these statistical levels, and here we are on the monthly too for the VIX, and that caught a bid, 1892, right on the line. Sure did. Look at that. So that is also a tell that if volatility is going to be rising a little bit, that's going to flatten out those longs. And you can see that the VIX turned around underneath its daily dynamic mean. So you see your mean is that Globex open, but the dynamic mean is floating with the volatility. So, and then we can go into some literature in a different video as far as what all these levels are and how to use them in your trading. But I'm giving you friction on 2 time frames, 60-minute and daily. And the reason this is no values for the 60-minute and the daily on this line is because this is the VIX. There, it's redundant. You've got the levels right here. You don't need them twice. But if we change this to the ES chart, you'll see that those are populated. You have 2 different levels. Here we go. You can see that you've got the 60-minute, the native, and then the VIX 60-minute and native. So this is the native. This is your volatility just for the instrument itself. And then you can see here that the VIX added to that isomorphically is lower than the daily. So if your volatility is lower than what the daily alignment is, you can see that you're 63% of that range, of the daily range. So if your one period daily range, we can look, show you a trick. You can put your PT, oh, I've already got it on here, hang on. Right click and restore this. Oh, no I don't, that's the momentum. I can show you how to get that blah momentum on your chart if you would like it. See the momentum is crushed. And you can see the momentum over here is bearish. That matches, matchy. So you can put your PT2 indicator on here. You can use either the 2 or the higher time frame. I use the higher time frame a lot because it has an adjustment for the Sunday gap. I guess that's the best way for me to explain it to you. But if it's like Tuesday, Wednesday, Thursday, Friday, it doesn't make a difference. You could use 2 or higher time frame. But if it's Monday, I would use a higher time frame. Okay. So I'm going to change this to 3 lines. And change it. The default levels, when it's unchecked, use higher time frame value, will default to whatever time it is on your chart. So that's 5 minutes. So these are points. So you can see the 1, 2, 3 of a 5-minute range. 4.5 points per 5-minute bar. Not very much. You can see how very constrained the market is. So daily 1, right there, 110, 78.75, and 39.50. That's our daily range. So if we're expecting 63% of the daily range, 63% of 110, put our trusted calculator back up. $69.30. So 69.30 points for the day. And if you go back to our bell curve, I guess I closed my chart down. Hang on one second. Pardon me, sorry. Hang on one second, I'll get it. I almost forgot what I was talking about. So you can see that 68% is inside this one huge thing, right? So that is 34% of each side of the mean. So it's from the mean to the one is 34%. But it's also at the end of the 68% range. So that 3468 line is what is hit so many times. And our expected range for the two, the 68%, is 78, 75 points. 63 of the range. So that would be between 69 points, did I say? I forgot. Hang on. 69.3. So between 69.3 and 78 is where I would expect it. And the daily one, VIX, lined up perfectly as the resistance. Because I just showed you on the bell curve, it's structure, it's the 68% edge. It's actually 34% from the mean, but it's a 68% this level right here. And that's how the market is traded so far. So it moved from the top back to the mean, and it might go to the bottom now. So I hope this is all coming into focus for you and that you can understand how to use these levels. We're using actual VIX volatility. So we knew not to go up to this other higher upper one. We use the VIX volatility for the ES. This doesn't work as well on crude, for instance, because that is a support resistance commodity. It's not using VIX so much intraday to decide what its ranges are. It's more standard deviation, structural. The dealer algos, they're not using the VIX. But the ES and the SPX, oh yes. And you can even use it on NQ as well, but I'm primarily using it on ES and SPX. I don't really even use it on NQ. NQ has its own NDX, but I don't. I have asked to see if we can get the. There is a VIX for the NQ available as an index, but NinjaTrader doesn't have it, so I can't plot to it, so I'm not offering it. So basically, this is just for ES and SPX, which are the two most heavily traded instruments in the planet. Most all professional hedge funds and things like that will trade ES and SPX. And these are very valid for both options and futures. You can sell premium if it's going to be an inside day. Like right now, it's showing to be an inside day. You could sell premium, and that's exactly what you really should be doing. We wouldn't want to go long unless we traded outside the one and or the two. So we can get into the framework a little bit later. That Twitter post, the X post, actually talks about that framework a little bit. So so you see here how it went up to the Gaussian mean of JIVE, which is now acting as resistance. So we got the bounce from the lower mean to the upper mean. Oh, this lower mean is, I've got two different types. Let's go ahead and talk about the indicators again. The JIVE I've just been showing you is the VIX volatility. It actually, I calculated it two different ways. I calculated it on the statistical overnight levels, and that's called JIVE options. So if you want to sell premium, you would want to be looking at these levels primarily. And then if you're trading like put spreads, you want to keep your eye on the variance model, spear. Uh, the options model is shield, and the variance model is spear. Spear has got the dynamic calculations, and these are the ones that move dynamically. So you can see that this mean moved dynamically up, and we just lost, price closed under it. We just lost it. So that leads me to think it's going to be coming back to test these opens down here, or that lower mean potentially. Like I said, this is a delta or gamma positive day, gamma negative in VIX, gamma positive in ES, so that the algos come in and buy these dips. But it's just flat. Zero, where our momentum is at zero. It's sitting on the zero line. That's how flat it is on this 5-minute bar. So you can keep that in mind on the calculations and how I run them from the HVOL 14 period to the RVOL 1 period, and from the options open versus the variance. You know, if you want to be buying a call or something like that, you would want to be looking at these dynamic calculations because they're even higher. And then I run calcs on this Jats high-low engine, which is also new. And Jats high-low is pretty cool. It I took my probability target calculations, and instead of running it off the open or the prior close, I'm running them off the current session high or low. And it gives some great levels. Like right now, you can see this mean, the high-low mean right there is hugging price. Look. And you can customize these colors if you don't like my selection. Just come inside the platform, and the mean unfortunately is way down there. I added it last. I realized after I built it that I didn't have the mean in there. And one of the things that I'm learning is it's not easy to go back and just plop something down at the beginning of a code set because it'll break everything underneath it. All right, so there's that mean, the dynamic session mean of the high-low. And you see how that broke lower. It's trapping the market right here. So now it's like having your own volatility service because I've carved it up from the open to the close to the high and the low. I've given this all the ways. So you can look at your daily points, or if you want to trade a 60-minute level, you can change your properties and change it from daily to 60-minute, so you can see how many points are in an hour. All right, check this out. So here you can see that it's changing from 975 roughly every hour. It's about 975 points. And if we were to look at the past hour, we would see that it would be roughly 975 points from top to bottom. Or was it staying inside the structure, or was it breaking the structure, indicating that the market volatility was higher? And you can see the market volatility is not higher, and indeed, no single 5-minute bar exceeds that structure. And if I were to look for the last hour, going from that high of this mean down, you can see that's exactly where the algos came in to push it back up. Do you see that? You see how that works? So you can time your trades below these structures. So there's that high-low mean, 975 points below it, and the algos, that's where they come back in. So I would expect it to come down here to this lower mean, like I was saying, 68.60, and then get bought right back up. So, in an inside day, you can trade off this. I would trade with market instead of away from it. So this is a little counter trend trade inside an uptrend day. So it's that if you want to trade counter trend, that's up to you. So it's sort of like ranging, but so you see what I'm saying? It gets bought as it comes down here. So I would expect it to come all the way down to the 68.60 level. But there's your little hourly range. So that's how you can trade it intraday and get some definite trade ideas. Now, if you want to put a 60-minute distribution inside here, you can do that too. You can put the PT3 on the chart. And I colored these blue with hedges. These hedges are awesome on a 60-minute time frame, and they get hit a lot. So here's that 60-minute range right inside of our, oh, and look, it went from 975 to 1025. So it's floating around a little bit. This is dynamic. It's the HTF is dynamic. The PT2 by itself isn't as dynamic as this. But there's also another way to get that same hour, which you should be aware of, and that is by changing this to a 8:30 to 9:30 distribution. But you see how it got to the 10 points and just like it stops because it hit its target. It hit the range. So it's very hard for the dealers to get much more out of it. Let's see. Let's put on a 8:30 to 9:30 distribution. And I'm going to put it right on top of it. of the 60-minute 24/7. All right, there's a big difference. So you can see the 24/7 distribution is underneath the 8:30 to 9:30 distribution of 1550. So if we get a break of that 1025 range, if we get a breakout, where do you think it would go? It would go up to this 1550 points. So right now 1025, 1175, it broke it. So we potentially could run up to that 1550 within that hour or before 9:30. So you see how I'm doing that? I'm now that we broke the 1025 60-minute range, it's moving up to that range inside that hourly period. And what have I done to get this? I just put 8:30 to 9:30, but it's over the last 14 sessions. So they're looking specifically, the calculations are between 8:30 and 9:30 in the morning over the last 14 periods. So it's very statistically grounded that way versus taking 24-hour hourly periods. Big difference. And now you see we're getting some positive momentum. Um, so here we're back at our mean, and that's exactly where the algos, you would see them come in. And look, that's exactly where they came in. And let's see if they can take it up to that 68.80 back up there, which is at the top of that 1550 period. So that's how you can use Jats. And if you can arbitrage your hour envelopes with your 60-minute envelope and trade those breaks inside the gamma, whether you're going positive gamma, buy low, negative gamma, sell high. Yep. You could probably put together a pretty nice little structure using Jats PT. So I hope that makes sense to you. And I'm going to let you go. There's a lot more I can show you, but I'll give you some chart templates to start with. And like I said, it's just a matter of clicking your chart and loading one of the templates that you've saved. You can save them yourself, create a template and save it, and then come back and use it. But it's just nice having a football field, knowing your one, two, threes of these time periods, and then knowing where the market is going to trade to. So, inside that structure. So if you have any questions, feel free to shoot me a email. I don't do Ninja Trader training, and I don't have like Teams or a remote session support, but I would be glad to address any question in an email or perhaps do a video for you to explain something if you have a question. Shoot it in and I'll try to address it that way. All right. Thanks, guys. I appreciate you. Thanks again for subscribing. Talk to you later.